Good morning, good afternoon, good evening, everyone, depending on where you're dialing in from. I'd like to welcome you all to today's webinar on developing climate scenario analysis capabilities, leveraging on OSFI's standardized climate scenario analysis exercise, the SCSE. We are really excited to bring this webinar to you. Before we get started, some housekeeping items we want to get through. First of all, this session is being recorded, and we will share the recording as well as the slides that we'll be presenting today after the webinar. Ideally, everyone should be on mute, but if for any reason you see that you are not, please ensure that your mic is muted. And in terms of questions, so we will have a dedicated Q&A session after the presentation. However, if as we are going along, you have questions, please put them in the chat, and then we will go through them as well during that Q&A session. And then finally, we have a few polls during the meeting or during the session today. And so we encourage you to get involved and to participate even in the polls and in the session today. In terms of introductions, so my name is Andrea Amaise, and I will be presenting the webinar today with my colleague Pierre. Introduction to myself: I lead the risk and sustainability consulting practice at Forvis Mazars in Canada. In case you are not aware of Forvis Mazars, we're a professional service firm specializing in audit, tax, and advisory services. In terms of what we do in the risk and sustainability consulting practice, part of what we do is supporting financial institutions on their journey to integrate climate-related risk and to comply with regulatory requirements around climate risk management and sustainability reporting, such as OSFI's B15 climate risk management guideline. I've been working with financial services for over 13 years, where I have covered risk management, prudential regulation, business planning areas, and I'm really looking forward to today's conversation. Pierre, over to you to introduce yourself.
Thank you, Andrea, and good morning, everyone. My name is Pierre-Alexandre Germont, and I'm a director at Forvis Mazars in the UK and the Global Climate Risk Lead. I've been with Forvis Mazars for just over a year now, but I've gained experience previously in credit risk, climate risk, and quantitative modeling over different roles at Moody's and in the banking industry. At Forvis Mazars, I am working with financial institutions, mostly banks and insurers across the globe, helping them define, develop, and enhance their climate risk practice. So I'm very happy to meet you today, and I hope you will enjoy the webinar.
Fantastic. So in terms of what we are going to cover today, so we'll start with an introduction to climate scenario analysis and OSFI's SCSE, and then we will then dive into steps in developing your own internal climate scenario analysis framework and how you can build from what you are doing on the SCSE to enhance or advance your own internal framework. And then we'll have a conclusions, and like I said earlier, we'll have our Q&A session at the end. So before we get started, we want to launch our first poll. And really it's to get a sense of where people are at in their compliance with OSFI's B15, which is the overarching climate risk management regulatory requirement. So if you can please go into the poll, either use the code 83356126. And the question is, where is your financial institution in its journey to comply with OSFI's B15 climate risk management guide? Okay, so we are waiting to get responses. Okay. So we'll give it a few minutes. So either it's not yet begun, you've not yet begun your compliance efforts, you're currently, second option, understanding B15 requirements and developing your own compliance roadmap. Third option, actively implementing compliance program, but in the early stage of integrating climate risk. Fourth option, you're advanced in integrating the B15 requirements into your risk management strategy and governance and reporting processes. And the last option, you don't know. Okay.
Shall we look at the results?
Let's just give it one more minute. I can see one or two people coming in. Yes, let's take a look. Oh, see another response coming in here. Okay. All right. So, okay, so 60% of people are in that stage of understanding the requirement and developing your compliance roadmap. Okay, we still have some responses that have now come in. Fantastic. All right, so we'll close the poll here. So 50% of you, I think that's where a large number of people are in understanding what the requirements are and in building their compliance roadmap. Fantastic. Okay, so thank you very much for participating in that. So in terms of what we are going to, getting into the first section, what we're going to cover, first of all, is looking at the OSFI's standardized climate scenario analysis exercise. So if we go to the next slide, please. We wanted to set the scene on providing an overview of climate scenario analysis, first of all, before we get into OSFI's SCSC. And really is to, like I said, set that scene. What are we trying to achieve with a climate scenario analysis exercise? So with your climate scenario analysis, really it's to provide a very useful tool to help in identifying and assessing potential current and expected impact to business model across a range of possible future states. The idea with your climate scenario analysis is not to predict the future, but it's really more about answering what if questions and to help institutions be able to think about what kind of responses and what kind of actions and strategies that they should put in place by the time they see the answers to these what if assessments. So what you see with your climate scenario analysis is that it provides a very useful tool, and that's because carrying out this forward-looking assessment provides a view of how climate-related risks and opportunities can evolve over time. And really, it helps to assess the extent to which your risk management processes are effective, extent to which you need to build on your risk management processes, given how your risk profile will evolve over time. Another important benefit of carrying out your CSA is because it provides a useful way to assess resilience. By considering that range of possible alternatives, you can be able to assess the extent to which you need to alter some of your BAU assumptions. And so it's a very good resilience assessment tool. And it helps to assess potential business, strategic, and financial implications of climate-related risk and opportunities. Now, we know that carrying out a climate scenario analysis exercise can be complex and it can be very daunting. And so that is why what we see really is institutions starting off with a qualitative climate scenario analysis exercise where they rely on descriptive narratives to explore trends, relationships across a range of potential climate change implications. They now progress to more quantitative analysis, which relies on numerical data, relies on models to measure the potential impact. And as well, institutions use a combination of both. What we are going to focus on in today's webinar, and really the essence of the SCSC, is to get institutions to build their capabilities around conducting a quantitative climate scenario analysis exercise. And all of this linking through to what B15 requirement is, which is what we've stated here in Principle 4, which is the fact that financial institutions use the climate scenario analysis to assess the impact of climate-related risk on their business profile, business strategy, and business model. So now let's now get into an overview of the SCSC. And what we've put here in this picture is to give you a summary of what the SCSC is covering, the metrics, the kind of exposures, and the scenarios that are in scope of the exercise. As OSFI has said, this exercise is designed to be foundational, and it's really to help institutions to better understand potential impact of climate risk on their business and on their counterparties. So it's as an exercise, it's not really designed to size the risk, but really it's to help institutions gather data and build their capabilities on developing their own internal climate scenario analysis framework that is really more relevant to their portfolio and business model. And around 2 weeks ago, so OSFI had launched 2 consultations on their draft methodology. And I think around 2 weeks ago, they produced the final versions of the methodology, workbook, instructions, and questionnaire. And when you look at the final versions compared to what you see in the consultation, you can see that OSFI looked to simplify some of what it had earlier proposed. An example, for instance, is the materiality threshold, for instance, for market risk. FIs who are in scope of the SCSC, what you would see is for the market risk module specifically, it's mainly for FIs who have a total balance sheet, total assets rather, of $100 billion. So in that situation, you find out that a number of institutions that are in scope of SCSC do not have to complete the market risk module specifically because of that materiality threshold. Again, some of the way they've tried to simplify the exercise is on the physical risk module, they narrow down the locations that are in scope, what we will call the forward sortation areas. So what you would see is that for wildfire, it's mainly covering rural areas, for coastal flooding, mainly covering urban areas. All of this is, again, designed to make the exercise simpler. Basis of that, it's supposed to be foundational. The reporting date of the SCSC is for Q4 2023. However, you can use Q2 2024 reporting date if you meet 2 criteria. One is that you apply Q2 2024 data across all of the modules. So your credit risk, market risk, and the exposure assessment, applying that, if you choose to use Q2, applying that reporting date. That is one criteria. The second criteria is that the impact of choosing Q2 does not produce significantly different results than if you had picked your Q4 2023. So institutions who choose to use Q2 obviously have to satisfy those 2 criteria. But really, regarding the second one, they should be able to demonstrate to OSFI, if required, how they can prove that conclusion that indeed using Q2 2024 as a reporting date will not produce a significantly different result than Q4 2023. Finally, around the exercise, in terms of timelines. So, like I said, the final methodology or final methodology and workbook and all have come out. So institutions have up until Friday, December 13th, 2024 to submit the workbook for your credit risk and market risk module. And then January 24, 2025 to submit the questionnaire, which has qualitative responses, as well as the workbook for the real estate transition risk, flood, and wildfire risk exposure assessment. So that's setting the scene on the SCSC exercise. I don't know, Pierre, looking at what OSFI is asking for in this exercise, how will you compare this to what you see from working with clients in other jurisdictions where they have had similar regulatory stress testing?
Thank you, Andrea. So yeah, it's interesting to look at what the OSFI is doing this year. It's quite a shift as compared to other regulators like the Fed, the ECB, and the PRI in the last 2-3 years in terms of institutions and the scope. The other regulators have mostly focused on the largest institutions, most of the time banks, sometimes including insurers like the PRI. But we were not in large numbers like the OSFI. The OSFI, I think, is setting up a new threshold targeting the vast majority of regulated institutions. I think that makes the the exercise more interesting and insightful from that perspective, because a lot of the risks are very idiosyncratic to each bank, and not only the largest banks. So I would say that's the biggest difference that we see across regulatory exercises. Looking at the expectations in terms of the risks in scope, we see some nuances in terms of the asset classes that are under scope, that would be either only under credit risk or market risk, or vice versa. And some asset classes would be only on transition or physical risk. If we look at OSFI, most of the credit risk and market risk exposures for corporates are being assessed under the transition risk. And if we take, on the other hand, the real estate, so mortgage portfolios, these are assessed under transition and physical risk, but only from an exposure assessment perspective. From a time horizon and balance sheet assumption, we see similarities also across regulators, applying some short-term one-year assessment and some longer term on the transition risk side, up to 30 years. So here again, not much difference. One particular difference to note is the balance sheet assumption. OSFI, like most regulators, have suggested and asked for a static modeling of the balance sheet. It's interesting to see that the ECB offered both possibilities for the transition risk side, static and dynamic. Finally, on the scenarios used and recommended by the regulators, again, we see a lot of similarities, especially on the transition risk side, because most of the scenarios are benchmark or leveraging at least the NGFS scenarios. Where we tend to see the more differences, it's on the physical risk side, either on the RCP scenarios that have been used, or on the hazards that have been asked by the regulators. If we take OSFI, for instance, the focus was on coastal inundation and wildfire. If we take the Fed, it was a hurricane and a hazard of the bank's choice. If we take the ECB, it was drought and flood, for instance. So overall, I would say that the exercises are quite similar in the expectations with some nuances. What really makes the difference for OSFI is the number of institutions under scope.
Fantastic. Okay, great. Thank you very much, Pierre. If we go to our second poll, still using that same code, what is the question here is to rank the challenges your institutions faced in preparing for the SCSC. So we put 4 challenges in there. First one is difficulty in mapping the industry sectors or regions, geocoding location of physical assets. That's the second option. Third option, development, enhancement of models and tools for SCSC computation. And then the fourth option, determining qualitative responses to SCSC questionnaire. If you can. Okay, waiting to get some responses to that. All right, responses are coming in. Okay. We'll just give you 1 more minute. Yeah, I think we can show the results now, please. So what is coming up first is the development or enhancement of modules and tools for the SCSC computation, and then looking at the qualitative responses to the questionnaire. Okay, those are our top 2. And I think as we go on, even in the next session, which is really the meat of what we are going to talk about today, We will talk through on tools and models. And then as well, when you look at some of the qualitative responses, is around your internal climate scenario analysis framework. So I think the discussion of today will really help to provide more insight and information to bring in what you can put in for your qualitative responses. Thank you to everyone that participated. So if we go to the next section, if we go to the next slide, please. So what we want to show in this slide is actually a framework for how institutions can go about building their internal climate scenario analysis framework. And we would delve more into each step as we go on in the presentation. But just from an overview perspective, Pierre, can you please run us through these various steps?
Sure. So the idea of this section is really to give you some insights, some overview of the best practice we see across different jurisdictions, with the aim to build and perform bottom-up climate scenario analysis. Just in case the concept is unclear, in climate scenario analysis we have two approaches: top-down, which is shocking macro variables and then cascading down to asset levels, and bottom-up, which is shocking the assets and then aggregating up. The first step is to define the objective of the exercise, right? So it's first of all kind of designing the scope of your climate scenario analysis, kind of designing the strategy, what you want to do, right? What you want to assess, and how you want to do it. So some of the questions to ask yourself is, what climate risk drivers are relevant to my business? How do I want to model my balance sheet? What time horizon? So which is very much aligned with your book maturity, and so forth, and so on and so forth. Once this has been defined, you will be able to focus on the different enablers of your climate scenario analysis. The first one is designing a data management framework. And that is very, very important, right? Without this data management framework, you won't be able to perform much of the scenario analysis. What it means to define and design a data management framework means you need to look at what you have today in terms of data, what your climate scenario analysis strategy tells you want to do, and focus on the gaps. So come up with approaches, recommendations to build on your strength and work on your weaknesses. Once this is done, and part of the data gathering is for scenarios, it will be important to think about what scenarios I want to use, I need to use, that are relevant and adapted to, again, my asset classes and my business model, because not all scenarios fit all banks. Then we move on to the assessment, which is kind of the quantification, right? This is where we will introduce models. This is where we will actually move from the data and scenario gathering to applying them to the asset classes, right? And looking at selecting some climate adjusted KPIs that are relevant to what I want to do, and then looking at the results. Once this is done, once I've done my assessment, well, I need to report these results. I need to make sense of them. I need to leverage as much insight as I can from what the assessment has given me. And this is where I will document everything. And I will also report and communicate these results to the board and senior management. Finally, and this is probably a step further, the climate scenario analysis, best practice looks at how do I go beyond and make even more strategic use of my climate scenario analysis, which means now that I have performed this climate scenario analysis, how can I enhance and incorporate this assessment into other business streams to make them better? If we start with the first step, which is define, here I give an overview of what climate scenario analysis looks like, from the identification of physical risk and transition risk by portfolios, looking at transmission channels, so how each of these risks will actually interact with my asset classes, and how eventually the end game is how do I incorporate them into my financial risk, market risk, credit risk, liquidity risk, operational risk. If we focus on credit risk, the idea is how do I make them meaningful to the board and the senior management? Well, that will be looking at damages and losses on the properties, on the corporate values, and obviously on the credit risk metrics like the PD, the LGD, and the ECL. But first of all, what is important is the materiality assessment. Andrea, can you talk a bit about that?
Sure. I think what you're trying to achieve here with your materiality assessment is really bringing out the physical hazard transition elements, like you rightfully said, that are relevant to your strategies, to the sectors, geographies, and asset classes covered within the portfolio. Like we said earlier on when we're setting the scene around the climate scenario analysis exercise, SCSC is foundational. It's limited in what it's covering. And when we're looking at the differences, you could see how different regulators, for instance, on the physical risk side, or even the transition risk side, we're trying to come up with, or we're adopting different elements to make it more relevant to what is happening in their jurisdiction. The same thing really you are looking to achieve with your materiality assessment. That sets the scene on what is material to you. And I think it's important to understand that this is an assessment that would improve over time. And really, that should be your end goal of making sure that the way you are carrying out in this assessment, it's improving. And let me explain what I mean. For instance, when you're carrying out the materiality assessment and looking at it at a sector level, you can start off with getting more average industry data or average industry information. Then you're looking at how you build to gather more data on emissions, decarbonization strategy, impact on business models for counterparties within your own portfolio. So, because after all, we know that two companies within the same industry can have very different impacts. So your next phase is really gathering more customer or counterparty specific information, which you can then incorporate into your materiality assessment. But a good part of that is, and I think which we're going to touch on, and the next component is on data. To be able to say, look, I'm going to start off doing something somewhat generic, but look at how I gather more data specific to my portfolio, specific to the geographies that are key to me, and then that impute or that improvement of information comes and informs the materiality assessment. So, Pierre, I think we can move to the next section on data.
Sure. So this step, which I touched on a bit before, is the designing the data management framework. And this is instrumental to the climate scenario analysis. Like Andrea just rightly said, the banks, the financial institutions will need to look at the data they need risk by risk. So physical risk by physical risk, transition risk by transition risk, asset class by asset class, and geographical area by geographical area. So it's not an easy task, but it is absolutely needed to then perform the right climate scenario analysis. If I take an example, let's take a mortgage portfolio on the physical risk side. Well, I will need to look at the locations of these assets. And not only looking at the locations, I need to have the right hazard maps that will tell me whether these assets are prone to flooding, wildfire, hurricane, and so on and so forth. If I take another example, if I take a corporate portfolio on the transition risk side, well, I will also need to know the locations of these portfolios, the sectors, because I need to know how vulnerable they are, for instance, to CO2 emissions and the increase in its pricing. I will have to do the same work for the scenarios, right? If I want to build relevant scenarios, I need to have the right data behind. It could be macro data, it could be hazard data. And finally, but most and foremost, not only I will need to gather all the data, but I need to make sure that I identify any breach, right? Any gap so that I can work on them and make sure that I will bridge these gaps.
What we've shown here is a framework for managing all of that data, because what you will find out is that you would either have some of the challenges that you could get with data is either one, you have new data that you were not collecting before, that you would therefore now need to collect. Data that you may actually have been collecting before, but maybe not in a systematic way. For instance, Pierre was talking about mortgages. You want to assess transition risk, or and you're looking at the property, the age of the building. You want to assess vulnerability, and you are trying to get understanding of the foundation. There are some information that actually you may have been getting, but either you have not been systematically storing that information. That is point two. And then what we are saying here is actually how you then integrate. And sorry, another third thing is how you integrate all of this, because you will be having data coming a lot from external sources, internal sources, a framework on how do you now begin to integrate it. And that's what we are trying to show here with this framework. Now, I know Pierre talked about doing that data needs assessment and identifying what you need, what gaps. What we've seen and working with clients is you summarize all of that maybe in a data catalog as a good tool to track your data gaps. It's important that you are looking at who is owning, what's the ownership on the closure of those gaps, who the governance to monitor the closure of these gaps, what is reported into maybe data steering committees, something to think about. And then the governance that you have over assumptions, proxies, judgments that you make in the interim while you are gathering this data. It's also very important. Having a clear, we're talking about gathering data, a clear strategy on how you actually collect the data from your different counterparties. What tools, templates can you use to gather that information? And when you do, the measures that you have in place to check quality from both what you've received from your counterparties, like your clients, your suppliers, what you've also received from third-party providers, what kind of quality measures and controls, internal controls do you put in place around that data? And then managing that data within your IT infrastructure, deciding what tools you are going to use and how that integrates with your infrastructure. These are the things that, as you are looking at your data management, you also need to consider. So that is on data. So if we move to the next one on scenarios, Pierre.
Sure, thank you, Andrea. The scenario part is also very important. For the first reason is that there are commonly used scenarios from international bodies like the NGFS, the IEA, or the IPCC for transition and physical risk scenarios. Scenarios that have been mostly followed or benchmarked on by regulators like the OSFI or the regulators. That said, these scenarios do not necessarily apply to all banks, or some of these scenarios might be considered not good enough in a sense that they do not necessarily capture all the possibilities and severities of climate risk. And so what we see in other jurisdictions as best practice is some financial institutions are going through the exercise of designing their own scenarios. That could be based on their strategy, their climate risk strategy. That could be based on the specificity of their asset classes, the specificity of their book maturity. That could also be based on taking a different angle from the commonly used scenarios, which are very deterministic, and wanting to incorporate more of a stochastic approach. The last thing that we see more and more is the incorporation of tipping points, which are not necessarily yet captured in the standard scenarios, but which we see more and more incorporated because they have a significant impact, especially on the longer term. We will now move on to the assessment step. And here I will give you some best practice approaches that we see, especially in the credit risk space in Europe and other jurisdictions. So if I start with the corporate transition risk, the idea here is to leverage and overlay the financial institution's existing PD model. Right. So the idea is not to replace it. The idea is not to replace the model that is behind, but the idea is to take the baseline PDs of the financial institution and apply it, a Merton type model that will shock the baseline PD and make it climate adjusted. The real value of that is that you leverage your existing credit risk metrics, the PDs, and you can make them comparable to the climate adjusted PDs, because you can then just look at the shift in the PD. Some of the key elements and again advantages of this approach is the limited number of inputs that are needed in the model, because there are a lot of variables like the asset volatility or the pass-through probability that are already calibrated at sector levels, and then we will use some more company-specific inputs, such as the revenues or the asset value, to make the assessment really bottom-up. On the physical risk side, it is a similar approach in the sense that the idea is really to leverage the existing PD model of the financial institution and to apply it an overlay. That said, the modeling part is very different from the transition risk approach. Here, we need to look at, first of all, the exposure of the assets to the hazards. And that's what I was talking about in the data management framework. It is important to locate the physical assets of each of the corporates and using the appropriate hazard maps to be able to identify the list of hazards that are relevant to the assets. That's the first thing. The second thing will be for each of these hazards to build and model a gross damage function, which essentially will translate the exposure to the hazard into a damage on the physical assets. And at the same time, we want to focus on the residual portion of this damage. I mean by that, what we want to do is to incorporate any mitigation factor, like an insurance coverage or a state support, and really focus on the non-insured or non-covered portion of the damage. And once this is done, we focus on this uncovered portion, and we can then adjust and shock the asset value and the revenues of the corporate. And we kind of fall back into a similar concept as for the transition risk. We can integrate this into the PD, the LGD, and the ECL. So different steps and different approach because of the physical risk, but at the end, we fall back into a similar concept.
I think that's very interesting, if you Pierre, because as we know with the SCSC exercise, yes, we are the module covering credit risk is on transition risk, but on the credit risk side, not on physical risk. So because I think SCSC made it very clear, or OSFI made it very clear, that the PD factors that they had provided for both credit and market risk only considers transition risk. So bringing this view on how to incorporate that as well into looking at it from a physical risk perspective was one we just thought, okay, from looking at other jurisdictions, one that is material or tends to be for institutions. So this is actually creating a view of how to go about that. And so if we take the next one on the real estate, so with the SCSC, and that's what they said, look, it's foundational as well. And so that is why the it's really more asking for an exposure assessment as against to trying to quantify a damage function on it. The SCSC, like I said, is foundational. And so what we wanted to bring in here is how can you take that a bit further? So on the physical risk side, I talked about it earlier that yes, the SCSC covers some specific FSAs, which may not necessarily be material for your own profile. So it's now looking like, and I think as what Pierre had said earlier, how can you then gather those kind of data for the locations that are material to you? And then as well, looking at the transition risk side, the SCSC is a snapshot. But what you may want to begin to consider is really how does the timing and pace of transition risk, how that can evolve over time. What we want to present here now is looking at best practices of trying to do that. Right.
Thank you, Andrea. So it's very similar to what we were just discussing on the corporate side, right? The idea is to, again, on the physical risk side, identify the relevant hazards, collateral by collateral, so property by property, building by building, and again, build some gross damage functions, which will allow us to basically quantify the hazard damage, translate it into a loss on the property value, and again, mitigated by any potential insurance claims. And at the end, the real end game is to translate, again, this uncovered portion of the damage into an impact on the PD and the LGD. On the transition risk side, we will look at different components. What we see in Europe mostly is adjusting the equivalent of ERS score, which we call EPC rating in Europe, by looking at how the new regulations, the new laws, the new expectations in terms of especially energy consumption, adaptation and resilience of the properties will impact the ERS scores. And especially what we see in Europe is how we tend to see that the poor ERS scores are getting even poorer. And so that can have a significant impact on the collateral, because we can expect that these scores over time, by declining, will reduce actually the value of the property. And again, we can then include that into the PD and the LGD. But again, the real challenge here, on top of the, I would say the modeling approaches that are being used, is really to collect the right data, either on the hazard side, using the right maps, or on the transition risk side, using the right scores and the right regulations. Sorry.
So please continue, Pierre.
So moving on to the, actually it's a good transition from what we were just seeing. The OSFI, like most other regulators, has recommended to use a static balance sheet approach. What we see in other jurisdictions, especially in Europe, in the most advanced financial institutions, is the inclusion of a dynamic balance sheet. And that is a very interesting concept, because what we just said for mortgages or corporate is that over time, the value of the corporates, the value of the collateral, and so on and so forth will decline, and the associated revenues will decline, and the associated, let's say, PD or LGD will worsen. And so it makes sense to try and reflect that in the modeling of the balance sheet over time. Right. So some of the components that we use, or the financial institution use to model dynamic balance sheet, will be very portfolio idiosyncratic, like looking at the collateral values, looking at the CO2 emissions, looking at the corporate revenues, and so on and so forth. But this is combined with the bank strategy, the financial institution strategy, right? So do I want to have, for instance, let's say, 80-20 portfolio split between green and brown? Do I want to move into more renewable sectors, and so on and so forth? So that's also very important to take into account in addition to the outputs of the climate scenario analysis. And the other factor that most of these institutions take into account is the GDP projection. And that is also very important because knowing where the GDP is going country by country can also have an impact on where you want to go. So these are some of the key, I would say, metrics and components that the financial institutions take into account for the dynamic balance sheet. The next step is reporting. And to do so, it can be quite difficult and cumbersome for some institutions to manipulate all what we just discussed: data gathering, data collection, the models, the outputs, right? So some financial institutions, most advanced, have started using web tools or web applications that basically incorporate all this and help them navigate all this data, all these outputs, to make it more user-friendly, and also to allow them to build meaningful reports that they can then communicate internally. I'm giving here a few examples of these best practices. I was talking about the absolute need of hazard maps. Here I'm giving the example of a flood map of the Toronto Bay under the RCP scenario 8.5 with a time horizon of 2050. This is very important. Already just by screening a region, screening some addresses and postcodes, this will tell me how vulnerable my portfolio is to a certain hazard, here the flood, and where to focus. So here there's a color code from beige to red. I can already see and locate where the assets are more prone to flooding. So this will really help in the data management framework and the identification of these physical risks. If I take another example on the corporate transition risk, I was talking about the need to set up the right KPIs. And here, having this dashboard, selecting just a few KPIs, but exposure, CO2 emission, and what we call carbon intensity, which is the CO2 emission divided by the revenues. Again, these are meaningful insights. They already tell me which sectors are the most vulnerable to carbon intensity, and especially the increase in carbon pricing. And so this is the type of report that I will be able to then share internally, right? The map can also be interesting for institutions that have global exposures, because again, I can focus and communicate on the countries that are the most vulnerable. Finally, if we talk about the quantification and the incorporation into credit risk, having the right charts that are showing us let's say, for instance, the term structure and the evolution of the climate-adjusted probability of default under each scenario is useful, right? Because if I have let's say 100,000 assets in my portfolio with yearly PDs until 2050 in an Excel file, well, that will be very difficult to read. Having the right tool that extracts the most meaningful data out of it will be much more explainable internally. So these are examples of how financial institutions are integrating the climate scenario analysis into web tools that help them report more effectively internally. Finally, and this is the step beyond climate scenario analysis, which I was talking about beforehand. Financial institutions are now, some of the financial institutions are now in that stage where they go beyond the regulatory exercise and they try to leverage as much as they can this climate scenario analysis exercise and see how they can enhance some of their risk management functions or other business streams. If I give a few examples, some of the quick wins are the enhancement of the risk appetite framework by including some new threshold by sector, for instance, some new appetites by asset class. It could be the incorporation into the IFRS 9 framework. So the idea is not to replace the existing IFRS 9 framework, but rather run a parallel exercise to see what the adjusted PDs and LGDs would impact would have on the provisions, for instance. If I move on to other business streams, we've seen some financial institutions working on implementing climate scenario outputs assessment into their lending strategy. A very good example is enhancing the pre-screening process by simply inputting the location of the asset, giving directly the front office function the damage on the property, which translates into a red, amber, or green status. And already, by doing so, for instance, if it's red, well, they know that they cannot lend. Instead of going through the credit committee and so on and so forth, this is the type of enhancement that we've seen. On the loan pricing model, we see more and more, especially mortgage lenders, including climate-adjusted metrics into the model, especially on the PD side or the LGD side, and that reflects into adjustment on the pricing. Finally, on the reporting and disclosures, we see more and more financial institutions including quantitative climate-related impacts into the disclosure, and that makes a real difference to support their strategy, their vision, their disclosure, right? Being able to put numbers against the narrative makes a big difference. Andrea?
Okay. Fantastic. So as we come into the conclusions, and I want to take one or two questions before we give a concluding remark. But obviously, we've got. If you do have any questions, please put them in the chat message. I know we have 8 minutes left. Please put in your questions, and then we would go through. I have one or two that have come through. So obviously, thank you very much, Pierre. We have gone through the framework of building your internal climate scenario analysis exercise, defining your objective and scope, gathering the relevant data, designing scenarios that would be more relevant to your business, to your business profile, to your portfolio, undertaking and your assessment, and then looking at your approach to report key findings and your results, and then integrating these results into the way you look at risk management, the decisions that you're making in terms of lending, and also to your environment, to your reporting and disclosures. So before we get to the concluding remark, Pierre, if we take one or two questions that have come through, one question here is, any tools or best practices for calculating damage amounts?
Sure. So best practice, like I was referring to, is to build what we call vulnerability curve and severity curve, hazard by hazard. So to do so, you could use historical data from different sources. So that could be, for instance, historical data of wildfire or flooding in Canada, but ideally you would need to do it jurisdiction by jurisdiction. And then the idea is to project this data, right? So some of the best practice is to use what we call return periods, usually in the range of 1/100 to 1/1000, up to the time horizon that is usually prescribed. That would be, if we follow IPCC RCP scenarios, you're in the range of 2050. That's the first step. So once you've built your vulnerability and severity curves, damage by damage, hazard by hazard, you need to use a tool that gives you a damage and translate this damage into a loss. And so what we see in many cases is probability distribution. And this probability distribution will give you basically at a property level a percentage of damage, of loss onto the collateral value. So I hope that answers the question.
Yeah. Okay. And then just a bit of a follow on that as well. Would, in terms of vulnerability assessment of the portfolio, are these things that third financial institutions can get from third parties, or are you seeing more ownership of that, assessing vulnerability of their portfolio, that financial institutions are doing more in-house?
So by vulnerability, what do you mean exactly?
To be able to assess the extent to which certain assets have necessary defenses in place. Sure. Are they, especially the assumptions behind this, are they getting it more from third parties, or are they building those assumptions internally?
I think it's a mix of both. That really depends, again, on the data management framework that has been set at the start. I would say that the hazard data mostly come from external sources. So that could be data providers, that could be open source platforms. We see a lot of very good open source platforms working really well in that space. And then in terms of the assessment itself, so the tools, we see more and more financial institutions actually building internal tools. So they could still rely on some sort of external tool to some degree, but the best practice we see is really financial institutions trying to build their own internal framework, internal assessment, because they have the hand over the assessment. So it's a mix of both.
Fantastic. We have a message here. Yes, would the presentation slides be shared with us? Yes, we would share the presentation slides at the end of the session. And then we have another one here. Great presentation. Will the recording be shared? Yes, the recording as well will be shared with the slides. I think the last question before we conclude really is on scenarios, and picking between how do you bring in short-term scenarios into your own internal climate scenario analysis exercise. So that scenario component, how do you bring in more short-term elements into it?
Yeah, sure. So there is actually quite a bit of research that has been published recently, and which actually advise the audience to read, especially from the NGFS. They've made quite some progress on how financial institutions can build and incorporate short-term scenarios. But I would say that the main component of short-term scenarios, and I think that's probably more relevant to physical risk than transition risk, is again the right data. If I want to look at short-term scenarios, and by short-term we're probably looking at 1 to 3 years, maybe 5 years. Well, I need to have access to very recent data, because that's the most recent data that will probably be the most relevant to my short-term scenarios. When I look at the longer-term scenarios, the most recent data, it doesn't make a big difference. But for short-term scenarios, the most recent data will make the difference.
Fantastic. Okay, we have 1 minute left. If we conclude on key messages as people leave this webinar, that we would say key messages for them as takeaways.
Sure. So just some key messages to wrap up what we said today. The first thing before any work is to define your climate risk strategy. What do you want to do? How do you want to approach it? Do you simply want to complete the regulatory exercise? Do you want to listen and wait, or do you want to lead? And by leading, I mean, do you want to go beyond, right? Do you want, looking at some of the best practices we saw today? Then you need to prioritize your most important climate scenario capability issues. And this relates to what Andrea was mentioning about the importance of the materiality assessment right at the start. Then it's not too late to get started, right? It's a long and evolving process. We're just at the beginning of the climate risk assessment, so it's never too late to get started. And like we said, start with your strategy, but start also with your data management framework analysis, right? So that's probably what you want to start with to then build the right blocks and go into the right direction. Some of the key enablers for success is to set up an internal leadership and governance, so assign the right people, the right subject matter experts to it. Have the internal capacity and people, the right resources for data, for modeling, for reporting, and so on and so forth. The right technology. The right technology is very key, like we saw, to perform the stress testing. The stress testing is also very important. And for that, we saw you need the right tools, the right model approaches. And finally, the last word, which is nonetheless important, don't let perfect be the enemy of good, in the sense that it's not because you don't have, no one has the perfect solution, no one has the perfect model, otherwise we wouldn't be needed. The key here is to leverage your strength and work on your weaknesses. And again, it goes back to this data management framework and identifying the gaps and bridging them. So thank you very much for attending the webinar. I hope it was very informative for you.
Thank you very much. Please feel free to get in touch if you have any further questions or want to delve into any bits further. Thank you very much for joining and have a lovely rest of the day. Bye.